All right. Greetings to everyone. You're all welcome to Pros and Cons Accountancy Tutorials. As you may know, my name is Edward, and you can call me Ed. So today we would like to continue with our session that we started earlier on consolidation. And we are focusing on the net asset schedule of the subsidiary for now. And we've dealt with the net asset schedule in our earlier video, which was based basically on the financial position. So if let's say our scenario was actually on the financial position, and we made mention that we may have a scenario on the profit or loss, you may have a scenario on both profit or loss and then financial position. And you may also have a scenario on what the only the financial position. So if let's say you are going into an exam as a professional person, if you are going to write a professional exams, it's better you have three scenarios to work on: the financial position, the POL, and both financial position and POL. I can tell you that will strengthen your grounds and your understanding on the consolidation as a topic, right? So when we met the last time, we said for the net asset schedule, it is basically the asset that we are buying from the subsidiary. The asset we are buying from the subsidiary. So the parent uh, asset and then the NCI asset, we are adding all together as one. And we will need the net asset schedule at acquisition, at reporting, and then the difference will give us the post-acquisition profit. It means the profit we have been able to gain from buying this company. And that is what we call the post-acquisition profit, right? So normally, the difficulty student face is where they have to identify the retained earning when the question is on what? P or L. When the question is on profit or loss. Normally, that's where students find challenge. Finding what? Finding the retained earning. But that shouldn't be a problem for us. We will deal with it today and get to know. So there's a scenario we are going to use because I believe that based on what we did the last time, our earlier video, we will be able to understand what we are going to do today as well. So please, if you've not watched the last video that we did, then please and please again, I'll beg you to watch that video before you understand this one. At least you can even watch the beginning and then get to understand some of the issues before we come on this one. So today we are going to use a scenario, right? A full question, which is on P or L, but our focus will be on what? Our focus will be on the net asset schedule. But aside that, we will make sure we start because for now we've done about four mechanics, which is the group structure, the acquisition date and reporting date, the consideration, and we've also done the net asset schedule. Something we are also going to do again. We're also going to focus on today. So I want us to use a question to deal with the four mechanics that we've done, right? But the net asset schedule will be based on what? The POL. Okay. So let me share my scenario so that we can use that one to deal with the question, right? Okay. So this is it. This is Barca and then Chelsea. So this is for the football fan. Barca purchasing Chelsea. Somebody will say, why is Barca purchasing Chelsea and not Chelsea purchasing Barca? Because as it stands, if you're a football fan, you know that Barca is broke. Right? So why is Chelsea not purchasing Barca? But hey, this is just for scenario sake and for our study sake. So let's move on. So on 1st October 2023, Barca acquired 90 million of Chelsea's 150 million 0.5 CDs equity share. So it means Chelsea share is valued at what? 0.5 each. That's how they value it. But how is Barca going to purchase it? So Barca will pay 1.54 cash on 30th September 2024 for each share acquired. So if Barca has purchased 90 million out of the 150 million, they are going to pay what? 1.54 CDs for each of the 90 million that they purchased. That's the whole idea, right? But let's see, Chelsea's finance cost is what? 10%. Now, why do you think there's a finance cost? The finance cost is there because Barca is purchasing this company on 1st October, but the payment will happen on 30th September 2024, 1 year time. So this is a deferred consideration. And if you join our session on the deferred consideration, you understand that it is a future payment. So because it's a future payment, we need a discounting factor to discount it to the present. And that's why there's a finance cost there, right? So let's go and deal with what. So this is basically about the consideration. So we'll be dealing with the consideration, and we also have to deal with what the group structure. So we will start with our group structure, date of acquisition and reporting. Then we deal with the consideration. Then we come and focus on our net asset schedule, right? So when is the date of acquisition? The date of acquisition is 1st October 2023, and the date of reporting is 31st March 2024. So let's go and deal with the three mechanics. So if you look at our board, we have Barca purchasing Chelsea for 60%. What brought about the 60%, right? Let's see. Barca purchased 90 million of Chelsea's 150 million. So if you multiply this by 100, we are going to get 60%. We are getting what? Our 60%. So in that case, it means Barca purchased 60% of Chelsea. So that's what we see as our group structure. Now let's go to the date of acquisition. For the date of acquisition, we know that they purchased them on the 1st October 2023, and the reporting date was 31st March 2023, right? So it simply tells you that from October, November, December, January, February, March, that is 6 months. So this is a partial consolidation. It is not full consolidation because it's not 12 months. It is just what? 6 months. So our post-acquisition period, which is the period at which we acquired them to the period we are reporting, is just what? 6 months. It's just 6 months. So the post-acquisition period is 6 months. Okay. Now let's go to our consideration. When we were reading the question, we got to know that they purchased 90 million shares, right? But we want to use thousands. So 90 million, let's say 90,000 shares. But this 90,000 shares, they are going to pay 1.54 for each of them. 1.54 for each of them. So 90,000 multiplied by what? 1.54. But we will need to discount it also to the present. We will have to discount it to what? To the present. So if we are discounting it, then simply we know that when we're dealing with the deferred consideration, we say we need to discount it. And our discounting factor is 1 over 1 plus R raised to the power of what? N. N is the period, R is the rate. The rate is 10%, and then N is the period, which is just 1 year. The period they are deferring is just 1 year, right? They didn't defer for 2 years. They only deferred for 1 year because they purchased the company on 1st October and then paying 1st October 2023 and then paying in what? 31st September 2024, giving it what? 1 year, or one would say 12 months. Okay. So basically, this is what it will be 90,000 shares. So let me even add shares here. Multiplied by 1.54 CDs, right? Per share times the discounting factor, which is 1 over 1.1 raised to the power 1. So we can also say the discounting factor to be 1.1 raised to the power negative n, or say negative what? N. Negative n. And surely it's going to give you the same figure. It's going to give you the same figure. All right. So as I said, our focus is not on the group structure, nor date of acquisition and reporting, nor consideration. But you can see that it is very easy to put them down, right? So this is what we have. Now um let's go to the net asset schedule where our focus is today. The net asset schedule. In our earlier video on net asset schedule for the subsidiary, we said we will not use the asset, but rather the equity side. We'll use what? The ordinary shares. And we even explain why we are using ordinary shares. We are using the equity side instead of the asset side, isn't it? Good. You said the asset, you will not get the beginning and reporting, but for the equity, you get the beginning and what reporting. And we also mentioned that your net asset is as a result of what? The total asset less outstanding liabilities. But however, it should be equal to what? Your equity. In any case, all will be equal to what? Your equity. So we do this, then we now find, so we will use the equity, sorry, we will use the equity. Then we will now go and find if there is any other adjustment that need to be done. Any other adjustment that need to be done. So if you look at this question, they have 150,000 shares, and then each is 0.5. It is valued at 0.5. So it's 150,000 times 0.5 will give us 75,000. 75,000. So here will be that. Remember, reporting minus acquisition, as we said earlier. Reporting minus acquisition. So that will give you 75,000. Now, this is where the case is. How to find your retained earnings. That is where the issue is. Okay. Remember, post-acquisition, the period is just 6 months of the current. So anytime we talk about post-acquisition, it is talking about the current period. You've purchased it for 6 months. So the 6 months is the post-acquisition one. So whatever profit within that 6 months is what we bring as retained earning at what? Post-acquisition. Whatever profit within that 6 months that you acquired is what we bring as what? Retained earning under post-acquisition. So let's go to this. Let's look at our question and see the profit within the year and how much we can use as retained earning for the post-acquisition. The overall year, the retained earning is what? 80,000. The profit is 80,000. The profit for the year is 80,000. And I acquired you for just 6 months. So it means half of this is what I've been able to help for us to get. So when myself and then the NCI purchase the company, we have what? Half of the profit. We should get half of the profit. That is what myself or the BASA and then the NCI can share from Chess. So the post-acquisition profit is just 6 months. So if they purchase 8 months, you calculate 8 over 12 and multiply by the 80,000. 10 months, 10 over 12 multiplied by the 80,000. Right. So that is our post-acquisition profit. Let's go and put in our post-acquisition profit. So the post-acquisition profit is 40,000. Now we have our 40,000. The question is, what is the reporting profit? As at the time we are reporting, that whole profit of 80,000 will surely be there. It hasn't gone anywhere. It will surely be there. Right? That whole profit of 80,000 will be there. So we first have a certain profit for that year, this current year of 80,000. Of 80,000. Okay, let's put that one there. Of 80,000. But as at the time we were coming to acquire them, this profit, they had 40,000 of it. Because we are taking 40,000. That is from the time we came to the time we are reporting. So it means that already 40,000 existed. That 40,000 existed even before I came. So 40,000 here. Okay. That is also, so these two are profit for the year. These two, they are all profit for the year. And this one is the total profit for the year. So if it is just for that year, then what was the retained earning there before even this 80,000 profit? What is the retained earning before even this 80,000 profit? Let's go and look at the question. Was there retained earning? Let's look at it. So with this question, if you read your note 4, it says that all items accrue evenly over the year unless otherwise indicated. Let's move on. Chelsea had retained earning of what? 70 million at 1st April 2023. There were no other component of equity at that date. So let's be careful here. You purchased me on 1st October 2023. But the question is saying that even as at 1st, right? Even as at 1st April 2023, I had what? I had 70,000 before you came. So at the end of the day, it means that, oh, even even before all the years passed before you even came, I had 70 million there. So that 70,000 was waiting for you, was waiting even before you came for that year. So 70,000 was there. 70,000 was there. And from that April, right, to October, how many months is that? So April, May, June, July, August. So that was 1st April, right? So 1st April, May, June, July, August, September, and then October. That's giving us about I think about no, it is 1st October. So April, May, June, July, August, September. So TF September is the same as what? 1st October. So that's 6 months. So that 6 months is what gave us the 40,000 profits. What gave us the 40,000 profit before you decided to purchase the company? This is so easy, right? Let's break it down for you to understand. We are saying that P&L or P or L has been given to you, right? The profit for the year. Calculate the number of months that the parent purchased. And here we are saying that the parent purchased only 6 months. So that profit for the year, the parent can only take part of 6 months profit. And that is what we put at what? The post-acquisition. Right? That's what we put at the post-acquisition. Whatever profit is left from that profit for the year is profit we came to meet. So that is at acquisition. So that is this 40,000. That is this 40,000. However, the total 80,000 will be there at reporting. Surely the total 80,000 will be there at the reporting. So that is this 80,000. So this 80,000 is as a result of our post-acquisition profit with for the year, our post-acquisition profit for that same year, plus what the profit we came to meet within that same year. That's giving us the 80,000. But even before we purchased the company, there was some retained earnings standing somewhere because these two, remember these two are profit for the year. But the 70,000 is a retained earning which was there from previous years, even before they started the current year. So it means my profit asset acquisition is what? My profit asset acquisition will be 70,000 plus 40,000. So what do we get? That gives us 110,000. 110,000. Remember our scenario, we always say that it is reporting minus acquisition. Reporting minus acquisition, which will give us the post-acquisition. So the question you ask yourself is, if post-acquisition is 40,000 and acquisition is 110,000, what should be my reporting figure? What will be my reporting figure? Simply, it means it is going to be what? It is actually going to be the acquisition plus what? The post-acquisition figure. So that tells you that at the end of the year, at the end of, or at the reporting date, that year has given us 80,000. And the previous years has also given us what? 70,000. So 70 plus 80 gives us 150,000. 150,000, which is the same as your acquisition plus the post-acquisition, which is 150,000. We shouldn't be confused about it because it is the cheapest to get when it comes to what? The P or L questions. It's the cheapest that you are going to get. So basically, that is how you are going to get what? Your retained earning. First, whatever has been given to you as the profit for the year, calculate the number of months purchased and put it at your post-acquisition, right? Then be looking for the retained earning before you purchase the company. And here, the retained earning at acquisition, sorry, the retained earning before you purchase the company, even before the acquisition period, the retained earning, that should be given to you, right? So if you have that one, add that of the end of year one, the profit for the at the end of year, and that will be what? That will be your reporting figure. That is actually going to be your reporting figure. If you like, deduct post acquisition from the reporting, you get your acquisition. So let's use another way. As I said, let's use another way. So the other way we can also do this is that for our post acquisition profit, we know to be 40,000. But the profit for the year, the overall profit for the year, which will be as reporting, is 80,000. And the profit and the retained earning, even before we came to purchase the company, is 70,000, right? So in all, we get total retained earning to be what? 150,000. We get it to be 150,000. It is reporting minus acquisition. That's giving us the post acquisition. And we have reporting to be 150. We don't know here, but we know post acquisition to be 40, right? So what should we subtract from 150 to get 40? It is 110. This is the easiest way to deal with this. This is the easiest way to deal with your retained earning. So always take the number of months in the profit for the year. Come and put it at what? Post acquisition. Be looking for the profit, the retained earning before the acquisition period. The retained earning before the acquisition period. Then you add the total profit for the year to it. That will give you your reporting figure. Subtract your post-acquisition from the reporting to get your what? Your acquisition. That is all for the retained earning. Good. So this gives us our book value, as we may know. This gives us our book value. We have 185,000. And then this will give us how much? This will give us 225,000. Is it 225? 225,000. And then here we'll give us the 40,000. All right. So pardon me to go to the next board or the next page. So we have acquisition, reporting, and then post-acquisition. So ordinary shares, we have 75,000, 75,000, and then dash here. Then our retained earning, we have 110,000, and then 150,000, and 40,000. Okay. Now we've got so here to be 40,000, the book value. And then here to be 185,000, and then here to be 225,000. Okay. Then we said we need to deal with our fair value adjustments. First, we said any asset at all can be fair valued, and we can do what? Adjustment on that. Right. So what is is there any asset price which changed and Chelsea didn't know, and because of that, they didn't make any record on it when selling the company to Barca? Let's go and read the question and check. Okay. So if you read our first note, what are they saying? The fair value exercise on 1st October 2023 concluded that the carrying amount of Chelsea's net assets were equal to what? Their fair values, with the exceptions of what? So the exception is that one, plant with a remaining life of 2 years had a fair value of what? 6 million in excess of what? The current amount. So whatever Chelsea gave us, there was a certain plant, right? Whatever Chelsea gave to Barca, there was a certain plant which had a fair value in excess of what? 6 million. Because Chelsea had not been to the market, Chelsea will not know, right? But when we start and we say we want to do fair value exercise and go to the market and check, we will get to know that whether the price has increased or it has what? Come down. But this time around, thank God, it has gone up by what? 6 million. It had a useful life of what? 2 years. 2 years. And remember, in our past video, we said if the amount has increased, the fair value has increased, then it means we are going to get what? Additional depreciation. Additional depreciation. So it means if Chelsea gave it to us 10,000, we had already depreciated the 10,000 with the 2 years. So now we also have to depreciate the additional 6,000 which has come also with the 2 years because it should have been part of the cost. Should have been part of the total amount. Okay. So we have plant of how much? 6,000, which should be part. 6,000. All right. But we will have additional depreciation. And this additional depreciation will come as a result of 6,000 divided by 2 years. But you know that we purchased the company for only 6 months. So any P&L item will be just 6 months. It's going to be what? Just 6 months. So we multiply this by 6 over 12. We multiply it by 6 over 12. So 6,000 divided by 2 should have given us 3,000, right? But because it is half a year, it will be 1,500. To be 1,500. We don't depreciate at the beginning of the year, as we said. We don't depreciate at the beginning of the year. We depreciate at reporting or middle of the year, right? So the depreciation only have to come at the end of the year. Remember, reporting minus acquisition. So if we have a negative figure here, you have reporting minus acquisition, which is equal to the post-acquisition. If you have a negative figure, negative X minus 0 will give us what? Negative X. So that's why we have the negative also at the post-acquisition. Is there any other thing which we need to fair value? So let's go and see if there's any other thing that we need to fair value. Now, if you read the same thing, they said Barca placed a value of what? 5 million on Chelsea's what? Good relationship with its customers. Barca expected on average a customer relationship to last for what? A further 5 years. Amortization is charged to what? Administrative expenses. So here they are trying to tell you that if you charge amortization in dealing with the P&L, the consolidated P&L, the amortization should go to what? Administrative cost. And they said the depreciation is charged to cost of sales. So the additional depreciation you've got should go to what? Cost of sales. Under normal circumstance, if the question do not mention anything, then both amortization and then depreciation will go to your cost of sales. All right. So 5,000, which has a number of years of 5, but we are dealing with half a year, so we have to multiply by 6 over 12. This is an intangible asset, which is customer relation. So intangible asset of 5,000. And then we have amortization of 5,000. Amortization of 5,000 divided by 5 years. But we will have 6 over 12. And that will give us how much? So 5,000 divided by 5 should give us 1,000. So here will be 500. 500. 500. So here will be 500. Remember, we made mention that the subsidiary can sell something to the parent and make profit. That profit, it should be rewind. So we call something provision for unrealized profit. You have to unrealize it. You have to unrealize it. And we also made mention that if there's any other liability for which they've not settled, because we want to find net, then we will have to take out that liability as well. But let's go and look at this question. If you look at this question, the subsidiary didn't sell to the parent, right? The subsidiary didn't sell to the parent. It is rather the parent who sold to the subsidiary. But let's look at something. They said Chelsea's land value using the revaluation model increased by 1 million since what? The acquisition. This is a revaluation. This is revaluation. So with revaluation, we will deal with it another day because revaluation also is in IAS 16. So once we deal with revaluation, we will deal with this one as well. This, you may decide to either capture it in the net asset schedule or may decide not to, because this one will only be shared between what? The parents and the NCI. Will only be shared for the parent and the NCI. And if we decide to solve this question, I will let you know how you are supposed to treat this as well. All right. Now, after the acquisition, Barca sold goods to Chelsea. So you can see that Chelsea didn't sell to Barca. Chelsea actually didn't sell to Barca. It was Barca who sold to Chelsea. So there's no unrealized profit, right? No unrealized profit. But let's look at something. If you go on, you will see that there's nothing that Chelsea will add to the account again, because I remember during the introduction to the mechanics, I said the only account where you have what? The subsidiary is just the net asset schedule to the subsidiary. So whatever losses and profits and whatever additional depreciation because of the selling that they sold, whatever it is, if it is the subsidiary, then it will go to the net asset schedule. To go to the net asset schedule. If you look at it, there's nothing up for the for Chelsea again, right? There's nothing for Chelsea again. Okay, so it means we can close the net asset schedule. Let's go and close the net asset schedule. But I want to use this to explain how the PUP will be, how the provision for unrealized profits will be. So let me first close the net asset schedule, then we'll come back again and look at how the provision for unrealized profit will be if, let's say, it was sold by the subsidiary. Okay. So we have 40,000 less 2,000 will give us 38,000. Then we have 225,000 plus 6,000, which will give us 285,000. And then 285,000, let's say we less this 2,000 from this, it will give us 265,000. Plus 5,000 will give us 270,000, right? Let me use my calculator to see if I'm correct or wrong. 225,000 plus 6,000 minus 1,500. Then we add 5,000. Then we less 500. Let me do it again. 225,000, right? Plus 6,000 minus 1,500 plus 5,000 minus 500. That gives me 234,000. Yes. 234,000. 234,000. And then we have 185,000 plus 6,000 plus 5,000. That'll give us 196,000. 196,000. So you can see that if you have 234,000 minus 196,000, you are going to get you're actually going to get you're actually going to get your 38,000, right? 38,000. Okay. Okay, so let's use that note to explain how the PUP or the profits, the unrealized profits will be. So let's say they say Chelsea, no, sorry. After the acquisition, Barca sold goods of what? sold goods to Chelsea for 20 million at a 25% markup. Chelsea had 1/5 of these goods still in what inventory. Okay. Now, let's say it was Chelsea who sold to what Barca. Let's say it was Chelsea who sold to Barca. So if it was Chelsea that sold to Barca, Chelsea is selling 20 million, goods of 20 million. So let's say inventory, the sale is equal to what? 20,000 cities. And then the markup is 25%. The markup is 20. So what will be the unrealized profit on this? Now the question is, if we talk about unrealized profits, you see, we are one company. So if we are able to sell, even if I sell to you and I make profit, and you are also able to sell it outside, then it means you bring the profit to the company for all of us to enjoy. Is that not it? Heh. But whatever has been left in the company, we have to unrealize the profit. Why? Why are we doing that? For IAS 2, for IAS 2, IAS 2 is on inventory, and it says that inventory should be valued at the lower of cost and net realizable value. So at the lower of the cost that you purchase the asset, and then the amount you can realize outside, right? So now, surely you've put profit on this. So the lower will be the cost, right? The lower will be the cost. So we forget about the profit and only concentrate on the what? On the cost. Now, this 20,000 that you sold, 20,000 that let's say Chelsea sold to Barca, Barca has been able to sell part of it. So it is left with just 1/5 of it. That's what the question said. The remainder is what? 1/5. So 1/5 times 20,000. What do we get? 1/5 times 20,000. I think that would give us 4,000. 1 divided by 5 times 20,000 will give us 4,000. So that is 4,000. That's what is left in what? Barca's account. So Barca's inventory is left with what? 4,000. Now, because we are one company, it will be part of the consolidated account. And this 4,000 includes costs plus profit. This 4,000 includes what? Cost plus profit. But it should be in our statement only at what? Cost, without what? Profit. It should be in our statement only at cost, without the profit. So we want to unrealize the profit. And how do we unrealize the profit? The idea is that the profit that you got was what? 25%. The profit was 25%. So we have to, if we want to unrealize that profit, then in that case, we will say that 25% divided by 125, because it's a markup. Markup will be add. If it is margin, then we want to subtract. So 25 over 125 times 4,000. So what do we get? We are going to get 25 divided by 125 times the 4,000, which is going to give us 800. So the PUP, or the unrealized profit, will be equal to what? 800. That is how we deal with what? The provision for unrealized profit. That is the provision for unrealized profit. So always know the amount they are selling and what is left and what was the markup percentage or the margin percentage. That is what we can do. In our subsequent video, I will try and explain the margin and the markup so that you get the understanding very well. So at this juncture, I want to call it a close so that we meet in our subsequent video and continue with this lecture. Today, our focus was on what? The net asset schedule. But remember, we were able to deal with the group structure, the date of acquisition and reporting, the consideration, and then we focused much on the net asset schedule. Thank you very much for today. But at this juncture, I will ask you to please like and then subscribe to our page for us. Help us grow whilst we give you the best, right? So all what I will tell you is try as much as possible to subscribe and like our video. If possible, you can even share with family and friends who are dealing with who are having challenges with either financial reporting or corporate reporting in writing of their professional course or even academia. Please try and then do that for us. God willing, we are going to meet again. And I say, bye bye.